All right. Welcome back to another episode of Exploring the Process. This week you've got, we'll call it the two OGs, Chris and Robert here. So thanks again. What a great combo we had with Scott last week. And we've been lucky enough to have a number of really great guests so far in Fracticat, Trend Wizzo, and Scott. So looking forward to having more on the docket coming up. So keep an eye out for those. I'll be on a little bit of holiday next week, but we're going to try to squeeze in another episode here, hopefully with the guests if we can line it up. But otherwise, you may get Chris and I. His boys were on holiday this week, so just a little bit of kind of winter break here happening in terms of the real world between the two of us, right? But yeah.
If you hear any shouting and screaming, it's just my kids killing each other.
Exactly. Awesome. So getting into kind of, I think this episode, we're going to kind of take it back a little bit, I think a few steps back, kind of to the beginning of not necessarily the beginning of where Chris started, but certainly a little bit about kind of some of the beginning of just easy tools to use that Chris has deployed and made available both in the Arena and Hedgeye, as well as I believe you used to post them on Twitter a decent amount. So these links are definitely available. So we're going to kind of review some other kind of free content, really, I guess, at the end of the day, right, that Chris created. And hopefully you'll find some value in them. I know when I was first getting going, they were quite helpful in terms of just, having a quick sheet that was basically already pre-built. It's really awesome. There's a number of folks right now. Hedgeye, created, basically sent out a Twitter notice yesterday about kind of like, tell me how Hedgeye has improved your process or improved your investing. And there's a number of folks like a gentleman named Brian who's sharing his Excel sheet that he has linked into TD Ameritrade's I think or swim platform, I believe it is. But anyway, getting a hair off topic here. So let me bring it back. Let me bring it back to what we're going to focus on today. So Chris is going to share a screen here, and maybe do you want to just start in terms of what inspired these sheets, or how they developed, because now they're very clean and are awesome. But I know they evolved over time, and you call them your janky sheets, which is as Mitchell from Other Side Asset Management might joked around the other day with us. It's he's like a bull in a china shop when it comes to Excel sheets. So, but yeah.
So a big part of it was obviously being in the UK. Everything's all focused. A lot of the stuff around Hedgeye is obviously focused around the US. So for me, I needed to try and take the quads as they were in the US and try and pull them back to what I was doing globally and in the UK. Okay. So a big part of the sheets that I made here are like all the tickers that are on the list. You'll know that are on the sheets, the sort of asset allocation sheets that Hedgeye shares.
Sure.
And the back test and all the different quad outcomes.
Okay.
So I was using that as a way to not just be spoon-fed everything that's coming up and noticing things that was coming from Hedgeye.
Sure.
That was I wanted to try and figure out everything that I could to try and, I almost said not front run, but I guess, yeah, front run, because I wanted to understand the US part as much as I could. Right. So that I could try and kind of reverse engineer it to have a more fleshed out part for the UK.
Sure. And now is that focus on UK like ETFs as well as I know the fixed income side was a big piece of what you were historically invested in, but were you also trying to apply it to kind of like UK ETFs or European ETFs and stuff like that?
In a way, yeah, but the big difference I've found are the dividend returns. So okay. much of UK and EU is all
like dividend oriented,
all income.
Yeah.
So that has the kind of absolute return, getting the terminology right, the nominal return and the absolute return can put things really off when you're trying to do a back test against it.
Right. Because you've got like a 5% dividend yield,
Yeah.
it's going to grossly impact, your stock only may be up to, or it might not, it might not be up in conjunction with like the index, but it's like within relative basis or nominal basis, it's going to, gotcha. That makes sense.
Just in terms of, for me, it wasn't necessarily for ETFs or anything, not even really individual equities. I don't like we've talked about before, the way that I kind of look at things is I use a lot of leverage, but because I use a lot of leverage, having 80%, even 90% cash isn't out of the ordinary for me.
Sure.
So my pension and things, mine and my wife's pension is really, really conservative.
Okay.
And
do you manage that yourself?
Yeah.
Yeah.
I do, but like that's got all of the boring stuff that doesn't really move.
Got it. Yeah.
And that's just a choice for me, because I am like really whipping it around when in the stuff that I do.
Sure.
So when I'm in something, I'm in it big with leverage, but a trade could be 20 minutes.
Right. And so, and will you have that time frame? Like you'll know, like, will you have like an exit level going into it? Like you'll be like, just for simple sake, if it's like your entry's 100 and you're like, I'm out at 105, or like I'm out at 102 or whatever, like will you have a designated spot where you, regardless of whether or not you think it'll keep running, you'll take profit and then will you do incrementally, kind of like following a bit of like coaching?
So I take it. Yeah. So the allocation and sizes is completely different, but in that way, yes, I kind of take my cost bases out.
Okay. So then you're running with like free money, basically.
Yeah.
And
a big part of that, it came up on the arena recently. Someone asked about it, and a big thing for me, it's different. Your trading will change if you, as soon as you go from having a salary and having the safety net of a salary to then being reliant, or however reliant you are on trading as an income, your mindset has to change. And that came out in the interview with Trend, right? Even though he still, he still works,
yeah.
But he treats his trading as a job, and that's a big, massive thing. The part that comes out when you have the safety net is all well and good. It completely changes to the part where it has to become almost like it has to become boring.
Right. And very
process.
That's right. I was going to say strategic, but I didn't. Yeah.
Like people get into options, but everything has to be quite linear, right? I'm doing this because, and everything has to be, you have to have a checklist. These are the 10 things I have to do before I enter a trade. So then at the end, at the end of the day, at the end of the hour, at the end of the month or the year, right, you can correlate everything and say, right, what did I get right? What did I get wrong? Were certain assets better than others? Why was that? And you can, more importantly, you can look at your mistakes and you can immediately say, well, I kind of skipped step 7 and 8 and I lost money, so it's my own fault.
Got it. I love that. Yeah. Sam's solid on Twitter. He's such a good, he's kind of newish to the process, but man, he is like soaking it up. He's like a sponge. It's awesome to see. And he asked me yesterday, he texted me. He was like, so in general, like how much time do you spend like on like your process? And I hadn't really done the math and like really ever. And I was like calculating it up, and it basically tallied up to about 25 to 30 hours a week. Right. And which is similar. Trend, I think, was like 30 to 40. So I was like, when he said that, I was like, damn, that's like a full-time job. And then when I started actually doing my math, I'm like, oh yeah, I guess it is basically like, no wonder I see my wife at dinner. And then, like,
I definitely found last year when I was trading crypto more that I was kind of glad that this quad 4 was on the horizon, because I was spending probably too much, and that you kind of get caught up at the time. Everything was going was going gangbusters and great, and
Yeah.
So
I've had to back off a little bit the last couple of weeks, just the day job's been quite demanding, and then I had a family thing happen last week, so I had to travel, and then with this upcoming holiday, I'm not going to be tied to my seat, so I was like, I've certainly gone a bit more neutral in the book, and sort of raised a bit more cash, because again, it's been slightly freeing, to be honest, like being in raising the cash over the last few weeks, right, and just sort of, because I'm not as I'm just not as tethered to it in terms of like, okay, I got to be on top of things, I'm on top of like my process, right, like I know what's happening, but I'm not necessarily I'm making the conscientious decision to like basically wait a bit, right? It's your point. I'm kind of, I'm doing some trades, or like I've got time frame set, right? So it's like I'm looking at something. So for instance, like last Wednesday, right, when it was been 8 days in a row, I believe, right, of market, like basically green days or positive days here in the U.S. And that to me was like a prime example of like, okay, this is when you go big, right? And so like I took bigger moves than I traditionally would have, right? In terms of like, normally I would have gone, maybe added 25, 50 basis points of like, a short triple Qs, but instead I went 100, right? Like at once, and then I did it again. And it's like, and so it's like one of those things where, you take those, but then you're bringing it off you're moving it, you're taking it off the table again more quickly, right? So like, covered some on Monday, right? Covered some more yesterday, covered some more yesterday, covered some more, today, right? So it's like, I think, like what you're referring to in terms of like your process and how you're approaching it, I'm certainly coming to the realization now that I don't have like a portfolio of like 80 positions that I'm like managing, which I had done for basically most of 2021. It's like, oh, cool. Like I can deploy, I can have just like kind of, call it 20-30% of my book just like invested, and then have the other 50% or 60, whatever it is, like go big when I see the prime opportunities to do so.
Just as long as it's within, something, you have to write that. There's certain parts that I write down. You have to write it down. This is the bit, like you kind of have to have this,
like the journaling process.
You have to have this trading plan.
Yeah.
So when you're saying, I know it's a conversation, but when you're saying get big, it has to have the confidence to get big, but within your risk limits.
Yeah, I mean, don't get me wrong. I'm in my parameters,
so,
right?
Yeah,
so short, I'm like max 3%, right? So like that's where I did not go over.
So
when I hit the 3% on Qs, I didn't actually even buy puts, right? I should have, but I didn't. But that, like, similar to what Keith mentioned this on the macro show, I think last Friday or maybe even Monday, and it was. It was like the cash position versus the like options position, right? And so like when he's out of basically room in his cash position, so for him shorts are 3%, his only way of juicing it more is to go the options route. And when you say leverage in the UK, you have more leverage products available to you, like for instance on gold that can basically juice it up 10-15%, but that's just like, it's basically like what is it called? It's got a specific name. What's the name again? You told me
CFD.
The CFD, perfect. Yeah. So, we don't have that here in the US, but basically, yes, when I say I go big, it's like, I still stick to my parameters. I'm not, I'm not, for instance, for an equity position, it's a 6% max position, right? For an ETF for security, it's, 2 to 3%. And again, depending on the beta, I beta adjust it, right? So like a Nike, I can take a little bit bigger, Disney, what have you, General Mills, Kellogg's, right? Like the lower beta, I allow myself to get bigger. But then there's other positions too, where like I'll cap it at 1 to 100, 150, 50 basis points, because the volatility is just out of control. And those are, again, these are lessons that I kind of learned throughout 2021, where I took the approach where I wasn't as stringent with those rules, especially when quad 2, right? You just kept letting it ride, or you kept adding it to the winners, and adding to winners is very critical. But then once you start getting offside on some of that stuff, all of a sudden mentally it's a challenge, right? Because you're like, well, shit, I was just up 20%. and now I'm up 5, or like, okay,
Yeah,
but
yeah, yeah.
I've got cost bases that are here because I was like adding to them on the way up, but now I'm underwater.
Yeah.
And it's like, do I take those losses? Do I not? Right. And it's just like, again, it's like a mental game as well, when the right move is to cut basically cut it back, bring it back into your back to your rules. But sometimes it's challenging to execute on that.
So in terms of that, so I was a trend follower before I found Hedgeye. So I kind of already had that. I don't want to say quant because it's not quant, but I already had the kind of rules based, if this then that.
Sure.
I wasn't listening to the news and buying stocks because Jim Cramer said this stock. No, I don't I didn't have that baggage.
Yeah.
I had other baggage of,
being a gold bug.
Yeah, I had that. Yeah. So I wear that badge, of being a reformed gold bug.
I'm just teasing.
But no, like the part that comes, like Keith always talks about, when it's up, you can sell some. You've earned the right. You've earned the right.
Yeah.
If you picked a good entry and you're up in that position, you've earned the right to take some profits. Like that's something like in trend following, at least the way that I was kind of learned how to do it. That wasn't it. You just let winners run, and then it gives back, and then it hits some kind of generic price-based stop loss.
Yeah.
So that's kind of why I made these, is because just the way that I do it. I know Keith and everyone, like a lot of people have, all these written notes. My written notes aren't numbers because I have all the numbers there. So
your written notes are more your actual journals. Like, whereas like I'm working on journaling it on the screen, like concurrently with my trades, you'll use your screens to help with the decision making to execute, and then you'll journal your actual like reasons for trading.
Yeah.
Interesting. And did you do that same thing with crypto too? When you were doing,
Mm-hmm.
So if you were buying Solano, you'd be like, I'm buying Solano because my signal says XYZ, and I hit, I put in a limit order for this, like whatever your rules are, right?
So that's it. Yeah. So
yeah,
I have
that's awesome.
So I have limit orders. I have, I am in the seat. I do this for a living, so I'm in the seat more than most. So things can trigger all the time, especially in crypto. At least they were, because things were just flying everywhere. Things were going up,
whipping around,
20% in a day. And I know this came up when we were talking to Scott, but it was like the biggest thing personally that I've taken, like in response to the question about how Hedgeye, how has Hedgeye helped your investment process? The big thing for me, being a trend follower, is you just had a shotgun. You were looking at everything, and you took shots at everything when everything triggered. And the biggest thing that I've taken is, now I have a sniper rifle. And a lot of the trend followers would say, well, that's the bad way of going, because you don't know where the outlier is going to come from.
Sure.
But you also don't get killed taking all these fake breakouts and stuff that get triggered all the time, right?
Right.
It's like, there might be an outlier, like oil. Okay, you've most recently missed that one, and that was a mistake. The reason why it was a mistake was because I did override one of the parts that was in my journal not to take it, because listening to the macro sharing things, it was like, this is coming and it's going to be big. So, and I listened. Whereas now I do have, if it's in the wrong quad and my trend following, if the system triggers, I still take it, but it's much smaller.
Awesome. So that's a great adjustment, because again, I mean, we've talked about this before, but like not all quads are built the same, right?
Exactly.
And so, and the back test is a back test, but there are also periods where those asset classes are positive in those regimes, and then also negative, right? So it's like,
because the most immediate responses to anything is come from, where does it just come from? And now obviously there's all kinds of stories and everything around.
Correct. I mean, like, it's a
whatever the reason is for oil, whether it's war, whether it's lack of production and all this kind of stuff, or whether it's just oil is just a massive component of value, and there's a lot of people have moved into value, and it's just, it could be anything. It could be anything, but it's, the back test is the back test, and as like I've explained however many times about expected value and the numbers that go into giving you the expected value by the quads. At the most basic level, there's quad 4 has happened 20 times and it's positive 50% of the time. Well, then there's 50% of the time it's negative. So and that's for everything, every single asset, every single quad. So that's the bit that I've changed, is I still do take shots when it's outside of the quad, but it's much smaller, because I know that the research and the back test and everything that goes with Hedgeye is much deeper than I have myself.
Big time. No, I think it's, and then the same component too, right? It's like, it's very challenging mentally to kind of forget about the past, or like, where, to your point about where you're coming from. It's like, if something, so like last Wednesday is a good example, right? It's been like up 8 days in a row. It's like, it doesn't, the NASDAQ, S&P, Russell, they all seem like they just kept having legs, and they were going to keep grinding higher on like low volume. But, having the conviction or the process, or basically a strategy, right? And executing on that strategy, and putting that, compartmentalizing, okay, the human nature component, and just executing. One, it's freeing, and two, it garners better results. and same thing on the upside, right? Like, you typically, again, like I do this, I was a habitual, I habitually did this all, like, for the first basically probably 18 months of my like Hedgeye like exposure. It was just, I had the hardest time trimming winners at the top, and I think mainly it was because I wasn't big enough in those assets.
And that's
and you don't, and you worry that you're going to go from, basically, let's just say you followed the process on buying it, right? So you did 25, 50 bit increments over the course of a day, 2 days, 4 days, whatever it was, right? Low in the range, you executed really well there. You got to 2% or 2.5%. And you're like, okay, awesome. I'm here. I've got my initial exposure. But then, the next day, it's just like, like gold recently, right? Like gold's ramped, right? I luckily, I think I'm around about an 8% position, but it wasn't until that most recent pullback, like 2 weeks ago, that I went big. I bought 150, 200 basis points basically over the course of like 2 days, and went from like a 4.5%, 5% position, and added, 3-4%, right? So, and my max on gold is 12. So, I'm not at max, and I can't wait for it to pull back, but it's just running, right? And now, I'm, Keith has been reiterating this really well lately, in terms of like, especially on the bond side, it was like, minimum, like, if it's something that you want to have exposure to over the full investing cycle, don't break your minimum exposure.
Yeah.
But if you're only at your minimum, it's very challenging to like, to execute at the top end of the range as well as the bottom end of the range, because you just don't have the capital to be able to really fully take the process to its full capability, right?
So just recently, so let's take the dollar and gold most recently, right?
Sure. Yeah. Great examples.
There was a cadence to everything. There was like, and if you got the first trade right, it allowed you to just kind of step through. If you got the dollar trade right, it allowed you to take profits and feed it into gold. And then the gold started working, not in this most recent ramp, but over the last sort of 2 to 3 weeks.
Yeah.
Right?
Basically since about mid-January.
This cadence, they were both kind of in a range and they both just kind of went, but if you screwed up the first one, you would end up being underwater maybe on the dollar position, or not wanting to take any profit because you don't really have any, that you may have missed the gold one. And then everything just snowballs and you're completely fucked.
Yeah.
Right.
Yeah.
So so you find some of these trades where it just gets into a cadence. And if you screw up along the way, especially whatever the first trigger is, if you screw that up, you don't just screw up one trade, you can screw up
a dozen,
5, 6, or 7.
Yeah.
So I definitely found it. I mean, some of like the videos that I made on building positions everyone always seems to comment on those. And
for those that aren't familiar, so Chris has a YouTube channel. It's cleverly named ETF Pro, and and so take a look. He's got about 20 or so, right? In varying lengths of time around different components of sort of building positions. ETF. I think he even reviewed some of these sheets, right? I think. Yeah.
There's some of these sheets. I've gone through things like what's in the macro show chart deck, like the IVOL table, the CFTC futures table, how to read them and stuff like that.
Yeah. We'll have to figure out how to try to combine our channels or something. That's a conversation for another day, guy. Awesome. Well, speaking of, why don't you want to share the screen and we can kind of dive into the sheets, and then
there you go. Is that up now?
Yeah, perfect. Awesome. So again, these are all
so as linked, you go through, right? You're just going to see the side of my head now. I'm sorry.
It's so good.
Right.
But, such a chiseled chin, though. It's a good chiseled chin.
I even had a shave. So as you're going through, so these are the kind of how the sheets that come from the.
Chris, do you mind maybe zooming in a hair, just that way, maybe up to the top, like factors exposure, just to kind of like show it where. I think if you,
they're going to change it.
I think you got to hit where it says 100% on the sheet right there. Yeah, click that 100. Oh, it's working. Yeah, go 150. Yeah, brilliant. That's way better. Awesome.
Better? Yeah. Okay.
Yeah, way better. Yeah.
So each of the they're the different sectors that are in the
quad map type
the
thing,
Hedgeye quad maps and stuff. Yeah. So I just do 1 day, 1 week, 1 month, 3 month, and year to date. Everyone's favorite. And then volume for me is all mainly it's this column here, so it's against the 1 month average.
Okay.
All right.
And so that's percentage change against the 1 month average, correct?
Yeah.
Okay.
And I tend to look, especially on these ones, because I don't trade the individual US equities or ETFs.
Okay.
So I made these sheets, like I said, to try and get a feel for the process. And I will admit, I was one of those people that thought I could just subscribe for a year and learn the map and learn how to do it all, and then just copy it and unsubscribe, right?
Mm-hmm. Yeah.
I was that guy.
That was 4 years ago.
yeah. So where are we? Feb. So like 4.5 years ago. Yeah. So I'll leave soon, right? So this comes from a lot. Obviously, Keith talks about 1 month. 1 month's the most important.
And then, so how do you use the bar chart? So so if you're looking at this and trying to apply it to say Europe, right? So again, we have a lot of Michael Bloom, tweeted yesterday that they have subscribers in 100 different countries, right? So I mean, you're not the only one that has this type of quote unquote issue, or not issue, but just like it's not as focused on the U.S. market, right? So then how would you? So how do you kind of take the bar chart there, say a volume versus 1 month, and try to apply that to your potential assets that you would trade in the UK?
So for me, but I'm just so I don't use these sheets.
Okay.
All right. Just to
Did you
understand, the
but
reason
did
why
you on the onset though? I mean, you had to build them for a reason, right?
yeah. So, but in like FX, you don't really get volume amounts when
Fair
you
enough.
trade
Yeah.
FX
Okay.
because
Fair enough.
and you can use the ETFs as a proxy, but then the ETFs like FXA or UUP are literally like such a tiny amount of the FX market
Yeah.
that to me, using those ETFs are like the little options position that you add at the bottom of a risk range of an
Right.
equity position.
Sure.
Right?
So then did you mainly build these
just
to better understand like why Keith
Hedgeye
might
overall?
why Keith might signal a buy on SPLV or
like I
or
said,
why he might, why he went bearish on like triple Qs or something like that? That's the main, so you built these more for understanding the thought process versus understanding rather than implementing them into your asset allocation.
Yeah.
That's amazing. That's amazing. So you built this. I mean, I'm at a bit of a loss for words, to be honest, because that's awesome, because this sheet is so robust in terms of like just the content that is on here. Again, I'm looking at this stuff on a every day across my tools, like so I most of my book is with Schwab. So they have like a platform, what have you. And so I have these watch lists and I have the 1 month, 1 month volume, percentage changes, all this kind of stuff, right? All much of what you have here. But I use it to actually execute, right? So like I use it to, impact, when I might buy SPLV or why I might go with, high beta or against high beta, whatever it might be, right? So that's awesome. That's really interesting.
I think on this sheet, the only thing I've ever bought is
gold.
TLT, gold. Yeah.
That's awesome. Well, hopefully for many listening, you'll be able to leverage this sheet and kind of use it as a snapshot. So let's keep rolling. Let's keep rolling. And we'll
So the main thing for me is, especially so I do trade the futures against like the S&P 500 and the NASDAQ.
Okay.
So I use that so I use this to look at the underlying, like what's going on underneath that.
Okay.
Because as you can see, like scrolling, you can clearly see that all these big, huge volume days all kind of come at the same time, especially in equities. They all come around the same time, right?
Yep.
And then it kind of all separates out as you go along. So as you go down fixed income, the kind of these big, huge volume days kind of happen around the same time, but it's not as pronounced as it is.
Not as pronounced as the equities, for sure. Yeah. Yeah.
And in a way, you do need to watch that, because in Europe, we obviously do have our own vol, but in Europe and Asia, everyone looks at the VIX as well.
Right.
That is their risk. That is their risk on and risk off parameter as well, because it's just so big and so liquid.
Yeah. Yeah.
So you can see when the VIX picks up, that 2 or 3 days later, you can see positions getting cut in Europe as well.
In Europe and Asia. Yeah, sure. Yeah, that makes sense.
So so these are all sorted. So I sort these by day, or if I post something like on a Monday morning, I'll sort them by the weekly performance, just to kind of tidy up to see where we are. And that's so I use these to look, and this is my kind of thing where I can say, it's been a quad 4 day, or it's been a quad 2 day, or, this week gold's been up, the dollar's been up, and equities are shit in the bed, right? Okay, that's a quad 4 week, right?
Yeah.
It's not that it's obvious, but it's just to get a feel, especially on the days when everything's not obvious.
Right.
Right. When things are,
and you got a lot of Brownian motion going on, or
exactly,
you're just like, a lot, low volume, trying to figure out what's happening.
Yeah, exactly.
Yeah. Yeah.
So then the trend part is split by 1 month and 3 month. So this number here is the 1 month high.
So that's the actual number high.
That's the actual
So
price.
SPOV, the last 1 month was 65.77. Got it.
And it's 16. So if you are using these, it's 16 calendar days. I couldn't get it to do trading days, but calendar days.
16 calendar days since the 1 month high.
Yeah.
Okay.
All right. And at the minute, very different to last year. All of these would have been green, pretty much. The last one left is XLE down here.
Sure.
And that's just green to say that the 1 month and the 3 month high are the same.
Got it.
So that's for me to say, right, it's got 1 and 3 month price momentum.
So meaning it has basically the best, like very good, like it's kind of bullish, at least.
So it just means
it's not Keith's bullish trend in trade, but it's like it's signaling, in theory, it's bullish trend in trade.
Yeah.
Yeah.
Yeah. And all the rest, like you can see, like Q's 3 month high.
Yeah.
3 month high was 91 days ago.
Yeah. It was like, a quarter.
24th of.
I think it was November 11th, wasn't it?
Yeah. So yeah. So that's how I use that. And these are just, and that's the other thing, especially in the factor space. Like we said about volume, everything kind of lines up. The factor space, everything just seems to kind of be really correlated, especially in these kind of trend little spark line things.
And so that's change from a 1 month high. So that's percent change.
Yeah.
So it's percent change from 1 month high. Got it.
So it's just a quick look. So you get it from the numbers, but I just like being able to just quickly look and say, you can just scan down all of them and say, well, a month ago, it was closer to this top line than it is now. So
right,
the trend is down.
Whereas like XLE, it's like right now, it's looks like it's kind of like at the bottom of its trend range.
But then as soon as you move, yeah, exactly.
Yeah, but then
right, and then as soon as you look, you can see
on 3 months, it's like, it's like not plateau, but it's relatively kind of plateau. It's like been pretty steady in terms of on a 3 month basis.
So because these aren't price, this isn't price. This is distance from the 3 month high. So that's why there's a straight line. It's basically any time that it's a straight line, it's been making new highs.
Oh, that makes sense.
Okay.
Because it basically defaults to zero, right?
Yeah. So each day, if it makes a new 1 month high and it goes 1% over,
it like defaults to zero.
The following day, it goes back to zero, and then it's either up or down. So you can see.
Yeah.
If it's just a straight line, it's been making a string of new highs.
Got it.
And then,
well,
volatility.
Given the fact that I have access to this, I really wish. I think many wish they still had XLE exposure. But hey, we're big. We're all big boys and girls and gals and whatever. And we could have. We have a go anywhere strategy. Could easily have maintained our XLE exposure. Yeah.
One of the things I'll say is there's posts that I made on the Arena about the high beta ETF.
Yeah.
If you go and look at those, I have some weird graphical charts with boxes and stuff. And as Keith says, although I think I didn't watch the macro show this morning, but I think you said that XLE has been added to the list.
It was, to the risk range. Yep. To replace XLU.
The problem is that for all of this time, the trend and trade lines have all been compressing and moving up. So very quickly, I'm not trying to talk people out of adding on dips, if that's what you're doing. It could very quickly turn from bullish to neutral because all of those trend and trade lines are really close to the price now.
Sure.
So you just have to be careful. That's
yeah. All right, so if we keep going across, you got the volatility. So it's just like the individual, you just pull that in.
So it's, no, I calculate that.
Okay.
And then the vol. And on another sheet, I combine these and kind of use a bit like VVIX over VIX that sometimes people share around, because it gives, the chart tends to look a bit more like this. So you kind of get a prominent big move in vol, so you can use it as a trigger.
So again, I'm just going back to XLE because it's the only green one, right? So it's like the only one that, in theory, I'm assuming from your rules that you would probably like consider, right? From what we're seeing. And with the volatility line there basically trending down, or certainly at what appears as like a recent, like towards the recent lows, that's giving you another reason to it's at basically it's near recent lows on a 1 month high, percent change from a 1 month high basis. Volatility is declining. If I go back over, to column P, you've got, it's down on like lower than average volume.
Yeah.
Right.
Then you have to take that into account, that the whole like volume as a whole is down across all the equity things.
Oh, 100%. Yeah. No, 100%.
So you have to factor that in as well. Yeah.
100%. Yep.
But if this, but
this is kind of, but in terms of your thought process, right?
Yeah.
You're looking at like, this is how you're combining basically a number of the different factors within that, like Keith preaches about and Keith incorporates into his process and his Hedgeye, decision making, the components that make up his decision-making process.
Volume and volatility. Yeah.
Correct. Thank you.
So if this had pulled back,
I don't know why I just didn't say that. Price, volume, volatility.
So if this had pulled back and volume had shot up, then that would be a red flag.
Right. Perfect. Okay.
But it hasn't. Excuse me.
Awesome.
So and then
what was the last couple of things? And then just correlations.
And then so just correlation tables at the end.
Perfect. And how? So I know those get shared a decent amount. What's your takeaway on these? I don't always have a good handle on like how to read these.
Well,
I mean, I understand correlation in numbers, Chris. Don't I'm not, but how do I know how to fucking read them, but
so I use it.
How does it impact? Like, I don't use correlations other than main ones like dollar bond correlations, gold, like big, to me, it's like more big macro correlations. I incorporate into my process. I don't go granularly in terms of correlations on, say, like US sectors.
So I use these. So these parts here are more like if we're in quad 2, although we've already talked about everything's different, not everything is static and the same. But
sure.
I use these more as in like if we're in quad 2 and XLE and XLF have been going gangbusters, and I don't know, XLY hasn't, but it's just triggered a buy. I do look and say, well, what's the correlation? Like, why? Maybe less as an entry to something. I just use that as a, why isn't that following the quad? If what's
got it?
And it doesn't necessarily mean that it'll.
So will you primarily just use the SPY one? You'll use that kind of bottom one, like SPY against.
So that's why I stuck that one at the bottom, just to see why, because then you can clearly see,
So basically, and so again, like the green means like if SPY is negative, it's more highly correlated, right? So right now that's saying that
so it doesn't mean
XLV, XLK are correlated more to like moves in the S&P.
Yeah.
Correct. And like XLK is like basically like 98%. So like they're like over 90%. So if the SPY goes down, it will likely go down. If it goes up, it goes up. Got it.
So I just use that as, that's more of, I put that in because the reason why I made this was to understand the quads better.
Sure. That makes perfect sense. Okay.
So that's why I have those.
Awesome. And then there's like 3 or 4 other sheets. Are they all, I mean, I know they all are similar look, so maybe we can just review.
So let's see
why you made, or the other components to why you made them. And then.
What one do you want to do? So there's the global one, which is a bit less. There's not as many.
Yes. I mean, did you use this to help? Yeah. I mean, do you invest in these markets? I mean, like what help? Which one?
Well, no,
do any
because
of them?
because you have to remember as well is that these are all the ETFs and they're all priced in dollars.
Oh, fair enough. Yeah.
So at any given time,
So really, all four of these sheets you really just made to better understand the correlation basically between decision making and execution and like what he hit on RTAs.
yeah,
Got it.
because
So
so for me, especially this sheet, I have access to other things that has exposure.
of course, yeah.
But I have to like everything. I've said it on other chats between us. It's like everything to me. Although I predominantly trade FX, even buying the S&P 500 is an FX trade for me because
Yeah. Like if the pound moves against the dollar in a negative manner, it's going to impact your returns.
Yeah.
Yeah.
So
like even if you're right, but then the pound moves against you, you're not going to be right as much.
Yeah.
Yeah. And we saw that last summer with Germany, right? Like we were, Germany, we many of us leveraged it through EWG, right? But then there's a USD euro component to that. And although the DAX kept moving higher and
you wouldn't have seen as much.
You didn't see as much of it because the dollar, yes, because the euro kept moving positively against the dollar, so or like negatively for us, right? So like the returns weren't as correlated to the returns of the DAX.
Yeah. So for me, I mean, if you follow any of the guys that are all vol traders, they say, everything is a vol trade. It's you're either long vol or short vol. It doesn't matter what it is.
Right.
For me,
and these these are all dollar trades.
And for me, everything on there is a dollar trade because
right.
I have to factor in the change in FX.
Yeah. And there's a component to like Russia's a good example. I don't have it pulled up in front of me, but I believe as of last weekend, the USD to the ruble, it's not the ruble, it's the Russian ruble. The ruble has been like crushed against the US dollar. Exactly. And that's a big component as to one of
the gold bug part of me is saying, oh yeah, but they're whatever the central bank of Russia is, it's like, oh yeah, but they've got like 50% of gold on their balance sheet. It's like, so that shouldn't be happening because they own all this gold.
Right. And gold's going up. Like, what is going on? But I mean, in terms of like the ETF though, right? I mean, like we're short Russia and it's like, it's having an outsized, downside performance because like the dollar is out. Not only is like the Russian index like down, but then the dollar against the ruble is up. Exactly, and so it's like having a double whammy.
But that's the thing. It works in both ways.
Correct. Yeah. So I just gave the example in Germany, but now it's working the opposite direction in terms of like FX is also benefiting.
And that's the thing. The one in quad 2, that's defined by the dollar going down, right? So that worked against you in that scenario. Using these ETFs, worked against you.
Yeah.
Whereas, like you said, short Russia right now through RSX. It's been turbocharged, not just
correct. Yeah, exactly. Cool. Is there any? So remind me. There's just like there's the ETFs for kind of like US or like general quad map. There's the global ETF, and then there's two others. One's I think crypto related, right? And then
so that one's not been updated for a while because I've not really followed.
That's fine. Yeah, that's fine. So
not really followed the Real Vision stuff at the minute.
Oh, then you have one for Europe, right? So it's like it's Europe.
Yeah, so I've got Europe
global, right? So it's Europe global and then US, right? Basically, or like the general. Yeah. Okay. Perfect. So for those listening, we'll share those three. We can link them in the description.
Yeah.
And then we'll share them on Twitter as well.
So although these are individual names, the volume and everything, like the.
Is this one of it? Do you publish this one or no?
Yep.
Yeah. Okay.
So I use the, what is it? GIX level 1, the sectors.
Okay.
So that's the MSCI indexes. So GICS level 1 is basically what like staples, discretionary, everything. So these are like the top 10 positions
inside those funds,
inside those indexes.
Right.
Yeah.
So you got utility, and that's for Europe, right? And as a whole.
Yeah.
Okay. So you got utilities. So you had basically all the same sector level stuff at the top, and then you break it down by individual security at the bottom.
Yeah, that's it.
Cool.
And then
there's some green on this screen. Look at that.
Yeah, there is. Yeah, there's been a lot of this, especially in the UK. I'll share the UK chart.
Chasing yield.
Yeah, yeah. But there's a lot of green on here because there's a lot of trends that have still got 1 and 3 month price momentum.
Yep.
That a lot of things in the US haven't got.
Correct. Yeah, it's very.
On the UK one as well. The UK
I tweeted that out this morning. I've been like too focused on the US. I need to get back to basics and because there's places to be again. Like I got no problem. Again, I got no problems being cash right now, but I need a position for myself coming out of basically this holiday next week where I can start deploying, especially, on dips in the US, but also just dips overseas and that kind of stuff. I need to start going back to, getting, because there's opportunities out there, whether it's individual, global ETFs or even some international names. There's opportunities out there, and I've just been too focused on like shorting the US basically. I mean, it's bloody fun, so it's like, why not? But but I need, there's a way to keep, on up days in the US where my shorts aren't working. Again, I've got long exposure, don't get me wrong, but it should be bigger.
It was interesting while everything, although there might have been this pivot on oil recently, when, as Keith was slowly changing his European exposure, and he said the kind of last leg, the only one left was France.
The CAC 40.
I kind of know why, because there's a big commodity exposure, but every day, I could see the trend in France kind of going down.
Oh, because it's got like Total and stuff in it, right? It's got like.
But the UK was just kept going up and up and up. It basically followed oil, and I was like, it's weird that. But then in the kind of in the messaging part, a big part of the coaching is the kind of messaging part of it, right?
Yeah.
I don't know his reasons why, but it was strange that he never picked up on the UK because it kept making new highs for weeks and weeks while things like Germany and France were getting, taken to the woodshed.
Yeah.
But I understand why, from a messaging perspective, is because the UK has a huge exposure to oil,
to energy, basically. Yeah, to commodities. Yeah. I mean, I know you said you missed the macro show this morning. And I know I also texted you this, but he basically, Gavin actually called out the fact that like the GBP to USD, like the FX, that's in the risk range there, it moved from, bearish to neutral to bullish this week, especially in bullish specifically this morning. Yeah. And so Gavin called that out and was like, is there something else that we should be paying attention to? And so he actually, the main thing was that the GBP has, I believe, again, I don't have my notes in front of me, but sorry, I don't have the screen in front of me, but I believe he said it was like 145-ish basis points for the 10-year, like the GBP 10-year note. And so it's like one of the highest basically in the world. And so it's basically getting funds, or it's attracting, investment in funds. And therefore it's, increasing the value of the pound. And however, coach said that, his preferred way of playing that would be pounds versus euros, because euros aren't going to do, they are dead set on not raising not raising interest rates. And so those are just going to continue to either be flat or fall. And so it's just going to continue to basically support the pound basically. So it seems like he's maybe turning around a little bit on some UK exposure.
Yeah. I mean,
and I know you've got other ways of expressing that. Yeah.
No, yeah, I do. Well,
But yeah, it doesn't really matter. But like,
just
yeah.
in terms of that, it's like the guy's job of running the company and running all this research, but then also staying on like
On top.
yeah, just having to like stay. Narratives kind of got this bad, but he has to stay on message about because as much as he says things like RTAs are like a signaling process, and they are, but it's and the macro show and everything is keep trying to keep people on track.
Yes.
If he starts, especially in the arena, it'll be interesting to see, because going long XLE, although it meets all of the criteria in terms of trade and trend, and it's had a recent pullback, so there's a better entry, it's trying to marry the message of quad 4 deflation with potentially the trade of going back to being long energy, because immediately it's off message.
Right.
Right.
It's on message in terms of it's on message in terms of like the signal before the quad, before the pod.
Definitely.
Which is always been his message. Signal before the quad, before the pod. And so he's going with the signal, regardless of the quad and the pod, because it's what he's seeing on his page. And that is his process. Is I don't care what anything else is, but the signal is basically his guiding light. So it's definitely on brand and on message there.
But if people are watching this, what I will say is, if you've screwed up the last few weeks or few months, oil could go on a tear to 100 and I'll look like a prick. But the last thing you want to do is pile in on this first kind of dip into energy.
Yeah.
Right.
Yeah. I mean, it's kind of what you said, I don't know, 20 minutes ago or half hour ago. It was, if it's non-quad oriented exposure, size it's smaller.
That's how I
that's what I'm saying. That's like I'm just repeat. I mean, this is about your our process. Your process is, if it's non-quad oriented, size is smaller. So if XLE is typically, again, I'm just using like coaches again, which I do follow, but like 6% would be a max in XLE, min would be 2, a mid would be 4, right? So take it to 2, or maybe start with 50 basis points or 100, and then see what happens over the course of the next few days, week, and go from there. But definitely, I think that's really it's a good approach,
especially like the longer I've done this, and the longer I've interacted with more people, and the longer that I've shared a lot of stuff on the arena and things like that, is especially in quad transitions, although we're kind of in the middle right now, people don't buy what they should buy at the time they should buy it.
They buy it. Yeah. Do you find that they typically buy it after it's gone up?
So then they move the prices of whatever. The price of XLE and XLF move in quad 2. They've moved. So then they look back at that little sheet that says what are the best things to buy, and they go, well, number 3 on the list is XLY, and that hasn't moved yet. So on the first little dip that it has, or whatever, there's like, well, I want to buy that because I missed the boat on those other 2.
Sure.
So there is a danger. You have to be, there's kind of that thing, is you can't just set and forget it. You have to pay attention to what's happening.
Yeah, big time. And hopefully these sheets are going to help, right? I mean, again, like in terms of just price, volume, volatility, right? I mean, the 3 core factors will help folks, who either haven't built this out or don't have their watch list set up, or, what have you. This will be a good tool. And although, again, I mean, you've built upon this and taken it to a whole nother level, which you and I know, like we've talked about, but, and maybe we'll talk about that down the road, but it's kind of proprietary. So don't get your hopes up out there, guys. And I probably shouldn't even have said anything, but anyway, but this is a great starting point. I mean, price, volume, volatility. I mentioned this on the notebook review on Wednesday night. I mean, it's been my core focus in every asset that I am either shorting or buying in the last month, specifically the last 3 weeks, has been, I've been just going back to the basics of price, volume, volatility. Volume has been anemic for almost every asset. But if it starts to pick up steam on something that I want to short, I will absolutely start to get bigger in it, even after it's moved, because that's just, I've gotten better at waiting for the move to confirm what I'm seeing on the page. And it is proven to be, at least in this current market, aka the chop bucket, to be a much more, patience has been probably the biggest resource that I've had beyond just price, volume, volatility, right? And as well as, coaching from Keith and, conversations with everybody else. But those two things, right? I mean, if I can just say anything right now, going into the back half of February, as we enter the end of Q1 and Q2, and the rate of change and the huge mountain of kind of negative momentum, change or rock that we're going to see, is keep a firm eye on price, volume, volatility. One of the reasons why we wanted to have this conversation today was to share these, because Chris has already been kind enough to be blasting them for for as long as I've been here. So for 2.5 years, or 2 years, and then patience. I think probably, unless you got something to add, but patience is crucial. And yeah.
Yeah, for sure. I mean, we've been kind of saying it for the last few weeks. It's like you could really, it's one of those things you could really screw up. You could really screw up your year by getting this part wrong. And in a way, I think we've definitely said this before, coming into the summer with your P&L as zero could be fantastic.
Yeah. Out of curiosity, I mean, again, if you can tell me to shut up, I share mine. I'll share mine at the end of market today, but I've made headway on year to date. I was down, I think at one point, probably close to 5%. I'm back to, as of Monday, I was back to about 90, down about 90, but call it a percent. So back down to, but had a very good, like last week was up. Again, I don't have my numbers in front of me, but I've clawed back. Basically what I'm trying to say is I've clawed back to my year to date to being much closer to flat. And that's basically my goal. My goal is going into basically Q2 to be flat to up. Whether, I don't know, that's my goal, is to be flat to up, because I want to be going into what should be a deep quad 4 and have my positioning on that's going to hopefully have me even more positive, ideally, again, being short the market or in other exposures, to really, get to the end of Q2 and at worst case scenario, flat, right? And ideally, and ideally positive, because that's my goal, right? But in terms of relative outperformance, even just being down 100 bips is very. I'm proud of that, and the fact that I've clawed back from being kind of almost clawed back from mirroring the S&P more closely, down kind of 5, 6, 7%. I'm proud that I've been able to pivot and sort of make better decisions, better execution the last few weeks.
Yeah, for sure. And it's like you've said, using the volatility buckets, it's about knowing what's a trade and what's something that you buy right now probably won't be in your portfolio maybe in 6 to 9 months.
Yeah,
it could be, but
could be. Yeah,
definitely shorts. Just like, you have to be really, really tight with shorts.
Yeah.
Because there's just such a massive structural momentum on things going up. People are still getting paid, which means money's still going
absolutely. There's passive flows coming in all the time.
Still going into their pension or whatever, 401k or So you just have to be really tight. And like you said, if it's not for you, if you're not bolted in, you don't have to be bolted into the seat necessarily, but even just buying the boring stuff, like especially right now, maybe layering into bonds more so than trying to do the hero trade of, nailing all these shorts and stuff.
Completely. Yeah. Awesome, man. Well, what a great conversation. I appreciate it. Thank you for sharing these sheets. This is, I think, I think Hedgeye Nation and the folks will really, hopefully they'll find great value in them. Again, even if it's just sort of a tool to have on one screen to help some decision making and sort of just another kind of tool in the toolbox, right? Another set of sheets to review ahead of time, ahead of making a decision. Hope you've enjoyed this conversation between Chris and I. It's always a pleasure, obviously, to sit down with you, and look for another episode next Friday. And we'll start hopefully bringing on some more guests and stuff like that and getting into their process. So good stuff, man. Appreciate it, buddy.
Yeah, no, thank you. Awesome.
Yeah.